Joining us now, DoubleLine Capital's Jeff Sherman and Bob Dahl from Crossmark Global Investments. Jeff, why the change in the bond sentiment this week, and does it continue?
Yeah, this is not really just directed only at the U.S. market, but this is more of a global phenomenon we've seen this week. As we've seen just more ugly pressures mount within the Eurozone. You're getting more reports of high inflation there. We know producer price indices are going off the charts, screaming just elevated levels, and just the amount of gas that's being allocated from Russia into the Eurozone is causing a lot of problems. And so what that means is it's more stagflation fears that are driving that area. So when you look at the bond rally you've seen this week, it was really incited by global bond yields and not necessarily just the U.S. And so you look at, for instance, the German 10-year has moved in about 13 basis points or so this week. It's somewhat commensurate with what we've also seen here in the U.S. And so I don't think it's something that it's the inflation reports or a change in sentiment at the Fed. This is simply kind of a global growth scare that led to a rally this week in rates. And you're seeing it kind of reverse today.
So it sounds like you're not convinced that rates have stabilized here or that this is the start of a new trend.
No, unfortunately not for bond investors. And I think you got to remain vigilant here, because what we also saw during this was we really saw some cracks within some of the darling childs of the credit market thus far this week. And so things like floating rate loans, which had been immune to the pain within the fixed income marketplace year to date. We saw some really soft trading in those names, really sloppy trading, but in somewhat an orderly manner. So it doesn't look like it's going to cause any long-term pain right now. But also, when you look at the triple C's, the lowest rated cohort within high-yield corporates, you really started to see a lot of pain in the last couple of weeks. By the way, the high-yield corporate market has had a tough time with issuance as well for the last couple of weeks. So there's some signs out there that look like there may be some, yes, exactly, maybe some issues there. But also remember, too, in hot inflation, we got CPI. We also got PPI, which tends to lead CPI inflation as well. And both of those things still have very elevated readings. So I don't think that the worst in the bond route is still behind us. But I do think we were oversold. You can see some of these conditions here. So potentially we're a little range bound before we look for new direction.
Jeff, thank you both for joining us.